Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 325 of the Independent Advisors Podcast. On today's show, we'll cover a few timely and important topics, including asset class money flows, current market sentiment, Federal Reserve expectations for their December meeting, and tech performance year-to-date, to name a few. Whether you're tuning in for market insights, planning tips, or just staying informed, there's something here for you. Let's jump in. Today, I'm joined by Nick Whitaker, Director of Research here at Jessup Wealth Management. Nick, thanks for coming on. How you doing, sir?
Well, I'm doing great. I think this is 2 weeks in a row for us, so that's fun.
I'm here for it.
Yeah, I'm here for it as well.
I'm here for it. I just made the comment before we started taping. I'm going old school paper for my notes.
I think I'm going to do that next time. You've inspired me.
I'm doodling on it. I got my little things that have come into my mind. This is perfect.
It feels more opening than me in front of my computer. I think next time I'll have to go paper.
It feels very freeing. I feel like I'm like one of those like news anchors where it's like I'm just going on to the next topic.
Yeah.
I'm here for it.
It looks cool. You look cool. You look cooler than me.
Thank you. Yeah. All right. For those that listen to on traditional podcasts, pull up the YouTube once in a while. You see what Nick and I are up to. So before we kind of talk about big headlines and current events, Nick, you want to update everyone on pricing, sir?
Yes. So as everybody knows who tunes in regularly, this pricing comes from Y Charts. It's as of yesterday's close, which was 11/3/2025. The S&P 500 is up 0.2% month to date and 16.5% year to date. The Dow Jones Industrial Average is down 0.5% month to date and up 11.3% year to date. The Nasdaq Composite is up 0.5% month to date and 23.4% year to date. The iShares Russell 2000 ETF, think small caps, is down 0.3% month to date and up 11.1% year to date. The Vanguard FTSE All-World ex-US Index is up 0.3% month to date and 27.0% year to date. Checking in on the Treasury market, our 3-month Treasury rate is sitting at 3.98%. Our 2-year Treasury rate is sitting at 3.6%. And our 10-year Treasury rate is sitting at 4.13%.
Before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today. Ooh, the 10 years barely holding on to a 4% handle. Barely. Just barely hanging on.
It's hanging on there, though. 4.13. We're still hanging.
The other observation when you were talking, it just makes me think about earlier in the year when the Dow was doing so well relative to the other indexes and international was doing so well compared to the other indexes, and just how much the S&P and Nasdaq have caught up, relatively speaking.
Yeah, the international at 27% year to date, and then the Nasdaq at 23.4. So, yeah, beginning of the year, if you go back to March, even earlier in the summer, those numbers were diverging much more than they are now.
Yeah, Another observation is starting to see the dollar strengthen over the past week against foreign currencies. It's going to be a headwind for international stocks.
It will.
You want to start with big headlines and current events, Mr. Whitaker?
Yeah. So we had a podcast just a couple of days ago, so not too much has changed since that last one. We're continuing to have pretty heavy earnings news, so you're going to see a lot of headlines with that.
Well said.
Generally positive for the market, though.
Yeah.
Underlying earnings have been generally strong.
I would agree with that statement.
There's always going to be pockets of weakness and pockets of strength, but generally speaking, positives over the last... Whoops. Sorry about that.
Hey, it's all right. We're recording, baby. This is awesome.
We are. Sorry, that's a vocal exercise, actually.
Love it.
Anybody who's
we are human. I think people always see us in our work environment.
Yes. So the other big headlines, the U.S.-China trade tensions have eased quite a bit. Both sides have agreed to lower or suspend certain tariffs, which is great. And the Fed signaled openness to a possible rate cut in December. That being said, the market expectations for a cut are holding steady around 65%
Probability,
right? And so that leads us into tweets and research. I don't want to jump too much into the Fed because I have a piece on that we'll dive into.
Well, I won't say anything. I was going to give some just my 2 cents, but I'm going to wait to hold it back.
We'll hold because I have a good one on that. So what do you have for us this week?
All right. So my first piece I have is it's kind of titled, cash is still pouring into money market funds. Okay. And the reason I'm going to talk about flows here in a second is I feel most investors, their feelings or their expectation is, well, the market's near an all-time high. Money just must be pouring hand over fist into stocks. So the first piece I'm going to talk about is a post by Mike Zaccardi on November 1st. And he's talking about flows over the past 12 months. The underlying data there source is Goldman Sachs. And it's showing flows into the three main asset classes of either money market, bonds or fixed income, or equities or stocks. And yes, there's been some flows into equities or stocks. You're going to see this chart will be put up by Jenna for our YouTube viewers. This will be in our show notes. But cash and bonds have drastically received the flows compared to stocks. So here's my prepared notes. Again, why am I highlighting this? Market sentiment is poor and the market is near an all-time high. I get concerned when sentiment is bullish and the market is near an all-time high, not the other way around. Lots of cash on the sidelines and everyone's waiting for a correction or a sell-off. And when we get it, will investors, whether they're institutions or individual investors, step up to the plate, or will they let the pitches go past thinking they'll get a better entry point? So then my next kind of piece that has to do with this same topic is Mike had another post from Goldman Sachs showing their proprietary U.S. equity sentiment indicator. And it is an indicator that has 9 measures of positioning across institutional, retail, and foreign investors. And Mike posted this on November 1st. I've been talking on our social media over the past week about what typically happens when Wall Street is behind the benchmark going into early November. Jenna posted a piece on our social media, Nick, about questions with Matt and Mark where I discussed this. Mm-hmm. And in my 20 years in this industry, 20 years plus in this industry, the playbook is pretty consistent. Money managers tend to chase the winners and momentum names into year end when they are underperforming this bad, and then they tend to sell them off in early January as they rebalance. Mm-hmm. Will that happen again this time? Maybe. Nothing's guaranteed. But that remains my base case until proven otherwise. Yes, there are cross currents like a government shutdown, but there are always cross currents. The real question is whether they're strong enough to disrupt the usual behavior. For those who are newer to the industry, when we say underperforming money managers will window dress because it's typically what they do at year end, here's what I mean by that. Heading into year end, some managers will buy the stocks that performed best during the year to appear smart on the year end reports. Then the calendar turns to January 1st. They typically unwind those trades and rotate into names they believe will outperform into the new year. This is exactly why listeners tune into the Independent Advisors podcast. We take these big picture Wall Street narratives and actually make them understandable. We preview the storylines we see forming so investors can anticipate what's coming and understand why markets behave the way they do. My prepared notes, Mr. Whitaker, thoughts, comments, my friend.
The one comment that jumped out to me, there was a section in there that said there will always be cross currents, like the government shutdown debate.
Yes.
Just food for thought for listeners that the government shutdown isn't necessarily a negative for a lot of these independent names that you might see window dressed at the end of the year. Right?
Sure.
they're going to continue to perform regardless if the government is shut down or not.
Yes.
Right.
And
so just food for thought that, yes, that's a cross current from a macroeconomic headwind, from a U.S. Economic societal headwind, understanding data, but from an individual company who's running their business, not necessarily a negative. It's just a factor in the equation, if that makes sense.
No, I think that's a good point. And, going back to the window dressing comment, that's where, a lot of investors, again, whether institutions or individuals, they tend to look at the year-end statement. They kind of see how the year went. They're looking to see what's in their portfolio. And that it tends to be why a lot of these money managers will buy names that performed well, because they want to appear smart, even though they might have only owned the name for 1 to 8 weeks.
Yeah.
They'll be like, oh, well, that's in the portfolio.
Yeah.
And they tend to unwind those pretty early in the new year and kind of rebalance, which is why I think you're going to see a lot of volatility right after the beginning of the new year.
And fun fact, that's why you also see volumes pick up in the last few days of the
Good point.
The calendar quarters. Is a combination of active money managers window dressing, but also the passive index funds reweighting their portfolios, or basically buying to kind of balance. You have all that happening in the last, let's say 5 to 10 trading sessions of the quarter, and that's why you tend to see a bit of a spike in volume.
Yeah, no, that's a good point. So my next piece is lots of talk lately about what Warren Buffett is doing.
I've seen a lot about that.
Right,
his cash position, right?
Cash position, his comments on the market, and I wanted to discuss it. Okay, so I saw a piece from Michael Nas, and he's a CMT. He's a quantitative and technical analyst covering U.S. equities. Got about 13,500 followers on X. He posted on November 1st the S&P 500 returns after Buffett built cash in a big way, and it's all relative. And his data points is roughly, what do you think here, about 10 different data points where, Buffett was vocal and underlying raising cash within the company of Berkshire Hathaway. And again, from a compliance perspective, not a recommendation for or against Berkshire Hathaway. But since Warren Buffett gets a lot of headlines, I want to discuss this. So we got to remember, the data points on Michael's piece of research here, again, 10 dates, and I'm going to name off a couple. June of 2024, September of 2021, January of 2008, July of 2007, January of 2007, and so forth, is when Buffett was really raising cash and doing it in a very public and vocal way. Is that a good way of saying it, Nick?
Yeah.
So here's my comments I prepared. Buffett and Berkshire Hathaway's goals, objectives, and time horizons are different from investors. They'll probably hold this cash until the market finally corrects. That time could be anything from a day from now. It might not be 6 months. It might not be for another 12 months. I think it's dangerous for investors to take their cues from others that have different goals. He could be raising cash to make a large purchase that none of us know about right now. Yeah. There could be lots of reasonings, especially a very different timetable than a retail investor. So in Michael's research here, he has not been a very good short-term indicator on the forward-looking performance on the market on a shorter-term basis. Yeah. And what Michael's showing here is that 6 months after these big cash raises, the odds are the market, historically at least, was higher. And then outside of predominantly the great financial crisis of 07, 08, and 09.
Yeah.
So again, here's my words of wisdom now in summary. Don't just watch the headlines and see people like Buffett raise cash and think that the market's instantaneously going to correct. Could it happen? Yes. But historically, it's not necessarily the best time indicator.
Right.
We know at some point the market's going to correct, but it could run another 10, 20, 30% before that happens. Your thoughts?
Yeah, my thoughts, and I'm sure if we went back in the podcast history, I've said something similar or I've commented about this, but I know that on an earnings call at some point in the past 2 years, I watched an interview, or I watched Buffett talking about his cash position and his thoughts around it. And you have to think of it from his perspective. Again, kind of piggybacking on what you're saying is it's not an apples to apples comparison when you're looking at who you are as an investor and what your financial goals are and Warren Buffett, right?
Mm-hmm.
Okay, Warren Buffett has had this great career, and he basically said that to where he said, at this point in my career, I just don't see a need to take great risks. And he's a big value guy from going and buying companies. So he's going to store up a bunch of cash. He's done this throughout his whole career.
Yep.
He stores up a bunch of cash, and he goes and he takes his risks on an individual company that he sees as a great value.
Correct.
And so what he's doing right now is, and he said this, he was vocal about this. I'm not going to say the exact date because I don't remember, but at some point in the past couple of years, he said he just doesn't see that opportunity out there. And where he is in his career and for his family and his shareholders, he just thinks, I don't need to take a big risk. So I'm happy to sit on this cash and just wait until an opportunity presents itself where it's a value-oriented company that he wants to buy. That's his playbook. And that playbook, that doesn't necessarily work for every investor. It might work for some, but I would wager that does not work for the average investor.
That's also my point. Exactly. And I just think that, those timelines and those goals are a lot different than most people. But the problem is these headlines are out there right now.
Yeah.
The headlines are out there that Buffett is cautious on the market, or they're assimilating that's the case because of all this cash that Berkshire is accumulating.
Right.
But it doesn't necessarily mean that they're not hoarding this cash. I think it's in excess of like $370 billion as of the end of last quarter for a specific reason.
Right.
Right.
And we won't know that because he's not going to come out and say it until after the cash is.
Why would you? Right.
Yeah, of course. Yeah.
All right. Here's my next thing. I want to talk about to our listeners and viewers the difference right now between the S&P 500 index itself versus the S&P 500 on an equal weighting basis. Mm-hmm. Okay. So my first thing is, I'm happy to take this if you don't want to. Nick, do you feel comfortable explaining the difference between the primary S&P 500 index that most people track and what the equal weight is? Or would you prefer that I explain that?
Yeah, I can do it.
Okay.
So, and jump in if you want to add
Yeah,
in.
go ahead. Run with it.
The S&P 500 is made up of 500 companies that are the largest market capitalization in the market, right?
Yep.
So essentially, they're just sorting it by how big these companies are, and that's the rank 1 through 500, and that's the weighting within the S&P 500. So the bigger the market cap, the bigger the weighting is in the S&P 500.
Bigger piece of the pie.
Bigger piece of the pie, exactly. So it's just based on how big the company is across those 500, and that's what the weight is.
Yep.
The equal weight is just taking those 500 names and saying they're all going to get the exact same weight.
Yes, no matter how big or small
No
they
matter
are.
how big or small, just across the board.
Well done. So why am I highlighting this? I saw this post from the Daily Chart book on November 3rd, okay? And what it was talking about is the S&P 500's equal weight, their 12-month rolling rate of return versus the normal market cap weighted S&P, which most people know, was outperforming by 2% in early July. That has dropped to negative 13% as of last Friday. That's according to S&P Global, was the underlying data source. There's a chart that was associated with this that goes back to 2019 that shows the rolling 1-year performance of what's doing better, the equal weight or the traditional market cap weighted. So here's my primary point and why I'm bringing this up in the podcast today, Nick. The concentration in this market, being a market cap weighted index, will provide some good investment opportunities at some point for names that don't make up the top 20 or 30 by market cap. The smaller large cap names, and I'm using air quotes for our traditional podcast listeners, will have their day in the sunshine. How long does this period of underperformance continue for these smaller large caps? I don't know. But what I can tell you right now is that 20 to 30 of the top market cap weighted names, they're the ones doing really well right now. Mm-hmm. And at some point that will change. We are at a point of almost where it's extreme, that the mega caps are disproportionately outperforming and doing better than a lot of the other names.
Yeah.
And I just want to highlight this because, again, we could go through a period of time at some point where the S&P, oh my gosh, the S&P is down 10%. But if you look at it on an equal weight basis, it might only be down 3, 4, 5%.
Yeah, on the relative scale.
On a relative scale. Yeah. So again, I'm highlighting this because you are seeing a lot of concentration in those top, say, 20 or 30 names by market cap. And things are definitely kind of getting out of whack. And it's just something I want to throw out there and just educate our listeners and viewers. Any other thoughts before you take over, sir?
No, I think that's excellent. People, I know people are reading about that, and there's been a lot of headlines about that, and it's important to know that just because those names can drag up the index and they can drag down the index, like you said, that doesn't mean the other 400 names can't do well. 450 names in the industry can do well.
Yeah.
And the market the S&P 500 can be down for the year, but those other names can be up.
That's right. And, if Mark were here, I know if he were here, this is exactly what he'd say. He would sit there and say, those top 20 or 30 names by market cap could continue to relatively outperform for an extended period of time. That is possible.
Absolutely.
We don't know when that switch is going to happen, but I do know, statistically speaking, at some point, it will switch for a period of time.
Absolutely.
Right?
Yeah.
Just the way the math works.
Right.
We wanted to take a minute and tell you about a service we personally use and trust, LifeLock by Norton. With everything we do online these days, protecting your identity and personal information is more important than ever. That's why we've partnered with LifeLock, a leader in the identity theft protection industry. Their mission is to empower people to live their digital lives safely, offering tools to help protect you and your family from threats like identity theft, cybercrime, and fraud. They combine advanced technology with 24/7 support to keep your information safer in today's connected world. We use it ourselves, and we think it's a valuable tool for anyone looking to add an extra layer of protection. If you're interested in checking it out, you can use our special link to get a discounted rate. As a heads up, we do receive a percentage of compensation if you sign up using our link, but we partnered with LifeLock because we believe in what they offer. To learn more and get the deal, just head to jessupwealthmanagement.com/LifeLock.
Nick, back to you. What do you got this week?
So my first topic is on a Fed cut in December. This is from briefing.com's The Big Picture, and we'll put the link in the show notes for anybody who wants to read the full article. It's a good article.
Nice.
And I'm just going to summarize what the article says, and we can toss it back and forth. So jump in as you see fit. In a nutshell, the market wants rate cuts, right? But briefing.com believes that a rate cut in December would be a mistake.
Okay.
So Fed Chair Powell came out. He said that a rate cut's not a foregone conclusion. It's far from it. Those views are differing a little bit across the street. The CME Fed Watch tool, which is the futures market that basically tracks a probability of the Fed's next cut, currently sits around 65% probability of a 25 bip rate cut in December. So 65% of the market thinks that there's going to be a quarter point rate cut in December.
Yep.
Right. And briefing.com says we think that would be a mistake.
Yes.
So they're kind of in the minority there. Right. Important to note that 65% is down from 90% a week ago after Powell's comments. So you're starting to see that narrative kind of change a little bit when you see the 90% fall to 65%.
I want to interject real quick because this is a
absolutely.
perfect example of the term Fed speak.
Yes.
Because a lot of times in the financial news media, they use the term Fed speak. But I don't think a lot of investors understand what the heck does that mean?
That's all it means is that somebody at the Fed said something.
That's right. So it's someone at the Federal Reserve, whether it is the Fed chair himself, Powell, or a regional bank governor, goes out, gives a speech, a Q&A, is on the news media one way or another, and is providing an opinion, a viewpoint, or a stance. That is Fed speak, and that just defined it. I wanted to throw that out there.
Yes, absolutely. So some Fed speak, after the FOMC meeting last week, market expectations for a quarter point cut dropped from 90% to 65%. Briefing.com is basically saying, hey, we think they should definitely not cut rates. Here's why.
Okay.
They say CPI inflation's at 3% year over year.
Yep.
Real GDP was 3.8% in the second quarter. It's projected to be 3.9% in the third quarter. The unemployment rate, as last checked before the government shut down, is 4.3%. The AI investment cycle is booming.
Yep.
The stock market's at record highs. It's led by mega cap stocks, which we just talked about, energized by some meme stocks. Junk bond spreads are about as tight as they've been in the last 30 years.
Yes.
Simply put, financial conditions are easy. And then he talks about the Chicago Fed National Financial Conditions Index, and we'll throw this chart up, which provides a weekly update on the U.S. financial conditions in money markets, debt markets, equity markets, et cetera, supports that financial conditions are easy. And we'll throw that chart up there, and you can just see that positive values are associated with tighter than average financial conditions, and negative values on that chart mean that those are looser than average financial conditions. So in a nutshell, this research piece is saying, given everything that we know from an economic perspective, cutting rates would be a mistake and could potentially lead to more inflation, which would be a bad thing for the market in the long run, which can be a hot take relative to the market, relative to 65% of the market thinking that we should raise rates, or at least expecting us, or not raise rates. 65% of the market's expecting us to cut rates in December, which is why I wanted to throw it out here, because I wanted to see your opinion on it. What do you think?
So I'm taking in everything you're saying as you're going through it. And for our newer listeners, Nick and I don't compare notes ahead of time, right? Nick has no idea what I'm going to discuss. Yeah. I don't know what Nick's going to discuss. Yeah. So you're truly catching me like, Matt, what's your initial take to this? Yeah. So as you're going through this, here's my raw thoughts, not in priority order. First, if they don't cut in December, I feel strongly they're going to cut at the end of January. They meet every 6 weeks. Okay. Through the lens of history, I've said this so many times, but I want to say it again. The slower the pace of rate cuts, the better it is for risk assets. Okay. And if we're not adding some booze to the punch bowl in December, but we add it in January, the party's still going to be pretty fun.
Right.
Okay. So I think with
that's an excellent analogy.
I still think with all that being said, underlying economic activity is a lot better than most headlines are indicating. Yeah. And I think that there is now this disconnect with the way the market is reacting and the way a lot of people's feelings are about the economy, especially in light of the short-term disruption of the government shutdown. Mm-hmm. I got a good friend of mine who's an air traffic controller, okay? The guy hasn't been paid in over a month, all right? Think about how that might affect someone of that stature's spending in the short term.
Right.
Do you think it's going to make an individual like that more conservative financially?
Yeah, absolutely.
Absolutely. Yeah. But we know the way these things tend to normalize. I'm not here to negate the negative effects of the government shutdown, but rather they tend to be more shorter term in nature. Yeah. In the underlying economic strength, I could make good arguments, is not going to be derailed by this, in my opinion.
I agree. Yeah.
Okay. So when I think of these, with where the Fed is at right now, the terminal rate of what they're offering banks to borrow money from them is about roughly 1% higher than this current inflation rate. And historically, the U.S. economy grows somewhere between 2.5% and 3.5% GDP growth a year. Mm-hmm. We're in the high threes right now.
Yeah, we're doing well.
I think that we should have a terminal rate today. This might be a hot take. I think we should be at 3.5%, 50 basis points ahead of the inflation rate. Is there room to come down? Yes, there is. Now, any politician that's in power, I don't care if they're Republican, I don't care if they're a Democrat, they want the economy humming.
Right.
So, of course, the current administration wants cheaper money. If I were in power, I would probably promote the same thing. I think with all this being said, the trajectory in the writing on the wall is very clear. We're going to have lower rates. It's a path of how quick we get there, and the economy will be rewarded, and you're going to have some more economic activity with cheaper cash.
Yep.
We're headed that way. I think we end up at a terminal rate in the low threes when the dust settles a year from now. Yeah. Might be a hot take. But we got to remember drastic amounts of cash right now on the sidelines.
Yeah.
It's happy right now earning high threes.
Yeah.
What happens when that goes sub 3?
When that goes sub 3, that's when you start seeing the rotation out of the money markets, and you're going to see it put to work in some capacity. You have to imagine it rolls into equities at least somewhat.
Thank you. And so when someone sits there and says to me, Matt, the market's at all-time high, I don't know what you think is going to propel this market higher. How about that 7.5 plus trillion that's sitting in cash? Oh, by the way, it's continuing to getting added to at record levels right now because no one likes the market on a short-term basis because it's too expensive.
Too expensive. And another thing we didn't even touch on that in thinking about rates coming down and why you're seeing so much pressure, I guess, from the financial news on cutting rates, and you see that 65% is the government debt, and rates getting lower to help that.
Yeah, I mean, I think there's things the market just has to realize that they're not going to be able to change.
Right.
And one of the things
don't fight the Fed.
Yeah, you don't fight the Fed. The printing of money is not going to stop. I don't care who's in power. And in order to have a truly balanced budget, the amount of pain that the economy would endure to make that happen, no politician is ever going to make that happen.
Yeah. Alrighty, that was a good one.
I'm here for this.
A lot of back and forth.
I'm here for the hot takes.
Okay, so my next piece is on tech year-to-date performance. This was an ex-post from the Trading Initiative on the 3rd. He said, here's the U.S. sector performance in 3 flavors year-to-date, April 7th to date and quarter to date. And one
April 7th is the low for the market earlier this year.
Yeah, post the sell-off earlier this year. And he said one thing is constant. Technology is leading all of them. And he had a nice line in here that I thought would be nice to remind listeners of is you have to obsessively focus on owning leading stocks in markets, in bull markets. It's hard and there will be doubts, but you aren't going to outperform the market by owning things that aren't outperforming the market, which sounds so obvious, but it's a decent point when you think about what's happened this year and
which proves my point
which
as to
is exactly
why I think they're going to chase them in November and December.
Which is exactly
the
what we're
playbook
talking
is
about.
clear.
So,
in my opinion, looking at history,
I grabbed one of those charts just to kind of show that for listeners, but the link will be in here as well, and you can just very clearly see that the tech sector is leading the market higher from April 7th to today, and that doesn't surprise anybody, but just a reminder.
Yeah, I mean, if you are a professional money manager and you're looking at all these different sectors of the market, whether it's financials, healthcare, technology, energy, consumer staples, go down the list. You're not looking at any one specific company. You're looking at just the sectors in general.
It's the 11 gig sectors.
And you just start looking at the generalities of, well, what's the earnings growth of these sectors year to date, trailing 1 year, 3, 5, and 10? What is going to be the debt to cash? Keep going down the metrics. Guess what? The technology sector's stats are sexy compared to everything else. They are. And so you're going to gravitate towards where your money is going to be treated the best. I mean, that's why tech, now there's trade-offs. Tech is a more volatile sector.
Absolutely.
Right?
Yeah.
And so I will argue, here's the hot take. When the growth rates on the AI data center spending boom, whether that's a year from now, 3, 4, or 5 years from now, once Wall Street picks up that the growth rates are slowing down, we will have a massive correction in the market.
Yeah, it's going to...
And I say massive, I'm talking in excess of 20%.
Yeah, there's going to be blood in the streets,
for
sure. Yeah.
And I personally, hot take, I don't think that's in the near term, say the next 6 months as an example.
Right. Yeah.
But I would argue that as professional money managers, if you said to me, Matt, what's the one thing that keeps you awake at night? Right now, it's trying to stay ahead of that curve.
Yeah, it's trying to, and I think and I actually talked with the client about this yesterday, but it's thinking about when are we going to get a good data points on the monetization of the AI.
Yeah, like
when do we, because we need data points on that.
Yes.
Right. And if those data points start to come in a little bit negative,
Like people aren't getting a good return on their investment.
exactly ROI on all the investment in the AI, and that is going to come down to how much and how quickly all the AI services out there can monetize their spending.
Correct.
And we don't have data points on that. We have an idea.
We have some
but-
headlines.
We have headlines, but
Not true. This is what my ROI
yes,
is.
exactly.
So I'll give you an example, not a recommendation for or against this stock, but it got headlines over the past couple of weeks, was JP Morgan Chase. So they are one of the early reporters in earnings seasons. A lot of the big banking stocks are. And they came out and said, listen, we invested X into AI. All they said is they got a significant return on investment. So instead of just taking that savings and adding it to their bottom line, they reinvested it into more AI.
Right.
And when you see headlines like that, it's no surprise to see the move in some of these tech names.
and the market generally has liked that.
Yes.
Going back to our headlines and saying the earnings have been generally positive, there's still been a lot of enthusiasm around companies just coming out and saying, hey, we're spending X amount of money on AI.
Yes.
The stocks have reacted favorably to that just because of some of these headlines that we're seeing.
And what always happens in these cycles, and again, this could be multiple years down the road,
It could.
there will be overcapacity in this space.
Absolutely.
There'll be too many data centers. The other hot take I've seen people say is the lifespan of some of these GPU units that are coming out of some of these semiconductor companies. You know, people think that, you know, you buy that GPU and you put it in a data center, oh, it's going to be good for a decade. I've seen some hot takes that some of these GPUs running 24/7 are only good for like 3 years.
I would argue that that's a positive for the AIs.
Good point. And so I just
If you think about it.
Yeah. Right. They're going to have to replace this stuff. It's not like you build a data center.
yeah.
They just announced here in a suburb of Dayton, Ohio, up in Sydney, just this morning, Amazon is building a $3 billion data center up there. Right. And so it's shiny, brand new. Let's say optimistically, this is up in the ground and running in a year. So you're telling me in 3 years after that they're going to have to replace all those GPUs and buy new ones? And it's like, I just look at it, at some point, these growth rates are going to come in. And that's when you see a larger, broader, more prolonged correction within tech.
Yeah.
And the whole market has been gaming when that's going to happen.
And it's going to drag the whole market down.
And it will when it happens.
Because, again, of what we talked about with market capitalization and some of those big high-flying names, not a recommendation for or against.
Yeah. This is a good roundtable, Nick.
This is. We've
This
really
is juicy.
We've really jumped around, and it's good.
I always love when we do the podcast together.
Yeah,
I am
it's fun.
blessed.
It's fun. So I think we can leave it there. My last piece was just a quick reminder from Ryan Detrick, and it's just not mixing politics and investing. And we've talked about that a lot. Don't mix politics and investing. There you go.
But it's interesting.
We'll throw the chart on there in the show notes if anyone's interested.
But I think it's an interesting one. And I'd like to just kind of finish with one thought on this. I feel it is human nature that individuals who might be passionate on one side of the political aisle or the other, to when their party's in power, that those individuals who are very passionate tend to be overconfident about that party's capability. And the opposite happens.
Yeah, or the vice versa.
Or the vice versa happens.
They're overconfident that things are going to go poorly.
Correct.
Right.
And we got to realize that in the C-suites of these boardrooms, they are not having conversations a lot about what's happening next quarter. The C-suites and the board of directors are talking about their 5 to 10 year game plans.
Yep.
And they are executing and already thinking about 2, 3, 4, 5 years out.
Yeah.
And with that mindset, you know, it's less dependent upon XYZ politicians in power and who's going to get in power in the midterms or who's going to win the next presidential election. It's tough, though, because so much of our personal lives and feelings at times can be dominated by partisan politics.
Absolutely.
When it comes to the investing world, it is so easier said than done. You got to stay as impartial as you can. It's hard.
It is hard. It's especially hard with the media. The media loves to stoke the fire.
Don't they?
They love to stoke the fire. So this came up. I saw it yesterday. I thought this would be. We'll throw the chart up, and we'll still put this in the show notes for everybody. But it just shows a chart of the candidates, whether they're Democratic or Republican, with the S&P 500, and you can see that the trend is up and to the right.
It is. It is.
So.
Well, this has been a good podcast.
Yes,
Nick, I always love doing it with you.
Yes,
it's always fun.
Ton of fun.
Well, that's it. Anything you want to leave with? I know we're on the tail end of earnings season. We got some earnings reports still hanging out there. Anything else top of mind?
No, hang in there. There's all these themes that we're talking about with the rate cut and earnings and government shutdown, that you're going to continue to see these themes over the next couple of weeks, and we'll continue to check in on it on a weekly basis.
One quick personal item. How's your fantasy football doing this year?
It's going very poorly. It's going very bad.
So we're in a
2-7,
bull market in the stock market, but Nick's fantasy footballs teams aren't doing so well.
Oh, we are a hardcore bear market in the fantasy football world for Nick this year, which is.
Are we talking like how close are we to being dead last in some of these?
We're in the league that I care the most about with some of my friends, where there is a punishment involved. I am second to last right now. And we're trying to squeak out wins here as the season comes to an end. I'll be 5 weeks here.
So are you going to have any relief, key players coming out of injury that are going to be reporting back soon? Do you have any light at the end of the tunnel here?
I had a pretty big light with Brock Bowers coming back, for anyone who knows.
Okay.
Brock Bowers came back last week and put up 44 points for me.
Okay.
Which is pretty good. He was only projected 12. So that took some pressure off. I'll say that.
Good.
I'll say that. So.
Well, here's the deal now. Next time you're on the podcast, at the end, got to give another update to fantasy football.
I will give another update, and I hope I will be reporting another win.
I love this. Well,
Please.
thanks, I love talking about this stuff. All right, thanks everyone for listening to episode 325 of the Independent Advisors Podcast. Myself, Nick, Jenna, Aaron, the whole team, Mark, we appreciate you listening and look forward to seeing you next week for 326.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.